Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. A Wall Street economist who served institutional clients at both Lehman Brothers and Bank of America, Michelle Meyer transitioned to Mastercard 2.5 years ago, now serving as the firm's Chief Economist and Head of the Mastercard Economics Institute. I had the opportunity to catch up with Michelle back in May. And while much, of course, has happened in the world since, there are some valuable insights shared in our discussion. We first surveyed the similarities and differences in her role at Mastercard versus the traditional sell-side economics role in which she served. Here she says that in terms of process, markets were formerly the output, but are now more of an input that informs her thinking on longer horizon economic trends and their implications. The audience, of course, is different as well, and hedge funds eager for insights on the most recent econ data release are not the priority they once were. We spend the bulk of our discussion on the vast and rich data set of transactions being generated by Mastercard in real time and around the globe. Michelle and team harness this anonymized data to better understand consumer trends in travel and goods versus services across geographies, even across zip codes. On this last part, we talk about two hyper-local surges in demand captured by the data, the Swift lift coming from Taylor Swift concerts, and the increased demand for goods and services along the April solar eclipse line of totality. Really fascinating data. I hope you enjoy this episode of the Alpha Exchange, my discussion with Michelle Meyer. My guest today on the Alpha Exchange is Michelle Meyer. She is the Chief Economist at Mastercard, also the head of the Mastercard Economics Institute. Michelle, it's a real pleasure to welcome you as a guest to the Alpha Exchange today.
Thank you, Dean. It's fun to be here.
I'm glad we got introduced, and I'm excited to have this conversation with someone who's had a long career on Wall Street in a traditional sell-side role and has made a really interesting switch in the current role you have now at Mastercard. So that'll be a topic of conversation. Why don't you get us underway and just give us a little bit of a flavor for your career history leading into how you arrived at Mastercard?
So I started my career a few years before the financial crisis, at the heart of the financial crisis at Lehman Brothers. So I joined as an economist in the research team, and Lehman was one of the best houses for research at that time. Very, very, very strong team of economists led by a very impressive head of research at Lehman Brothers. So it was an extraordinary opportunity to learn how to apply what I learned at school in academia to the real world. How do you break down complex economic concepts to ones that would matter for, at that time, an investor base? How do you think about the broad trends in the macroeconomy in the sense of how markets might move off of them? It was a lot of learning very quickly. I actually started to dig very deeply into the state of the housing market when I started, because there was the big debate at the time whether or not the housing market was in a bubble, whether or not prices were indeed overvalued. And the running belief at the time was that prices nationally do not fall, and they did not fall. It was always this concept of housing being localized, that you can have bubbles, you can have busts on a local level in the housing market, but you would not see that on a national level. And obviously, that was an assumption that was inaccurate. And it was one that, frankly, we challenged in our research when I started at Lehman Brothers. And we did some work at the time trying to understand what the ramifications would be if you had a decline in home prices, if you had some changes to the financial system that facilitated the run-up in home prices. So I got right into it very quickly in my career, and then was faced, of course, with the crisis, which was an important time in my life to understand how things can change so quickly, to understand the volatility in markets, to understand the fragility in the economy, and also to really appreciate the global linkages as well in the economy. To think that there was distress in Iceland because of US home prices declining was one that was hard to get your head around in real time. And now is one that we could all appreciate a lot more as we think about the distribution of risk of the financial system. So it was a lot of learning. It was great. I met Ethan Harris at Lehman Brothers. He was the US chief economist at the time. He is the person who hired me. He left Lehman Brothers. He went to Barclays, as did I, and then he left shortly after to go to Bank of America. And in a year's time after staying at Barclays, I joined him at Bank of America, where I spent about 11 years at Bank of America. And most recently, there was the US chief economist. So I really grew up a lot at Bank of America in terms of my career development, taking a lot more ownership of the forecasting process, ownership of the research production process, and getting deeper relationships with the client base at Bank of America. And it was a wonderful place to work with a wonderful group of people. And I'm extremely grateful to the opportunities I had there. It was a platform that was career building for me. And a lot of people trusted me to represent the views publicly and to very important clients. About 2.5 years ago, I made the decision to move over to Mastercard. And it was a hard decision to make because, as you pointed out, Dean, it was a departure from what I knew, from what I understood, from what I grew up in terms of being an economist on Wall Street on the sell side. I knew that job. I didn't know what it meant to be an economist anywhere else. But I'm so grateful and so appreciative that I had the opportunity to explore this and that I made the move. It opened my eyes to a whole new world of economics, thinking about the economy for a different audience rather than talking to an investor community explicitly. We're talking to a broad community, a bit more mainstream. Anybody who cares about the economy, whether it's corporations out there, it's a retailer, it's an issuer, obviously the payments world more directly. It's a bit more long-term in terms of how we think about the economy here than I did on the street. And probably the most exciting part, which I'm sure we'll talk about in more detail later, is the ability to leverage an extraordinary data set here at Mastercard that's global, to understand how consumers are spending in real time across the globe, across different sectors, is an incredible tool that has been really fun to explore.
I'm eager to learn more about that unique data set. And I'll just preview it by saying, just in visiting your website, it's just not what I would expect it to be. It's so interesting to see the focus on advisory that comes from being able to harness this data. And so it just seems to me that the company is over time gone down a really interesting set of paths, not just one path, not just a credit card. Obviously, there's just so much more to it. I was really interested to hear you start by talking about housing, and I can't help but bring in some of my own reflection as you talk about the 2004 and 5 experience and starting to look under the hood and ask yourself these questions around correlated movements in housing price appreciation. Can that be negative on a country basis rather than, as you just say, just these local busts? And there's some part of what you're saying just around the humility you have to have as a forecaster. I'm remembering Paulson well into 2007, maybe even into 2008, making statements that were just really at odds with what turned out to be the facts on the ground. So here's a Goldman vet who's the Treasury Secretary, armed with a fair amount of knowledge, contacts, and I think probably reams and reams of data, and really just misread it. There's got to be a lot of humility in this business that we're in. So such an interesting time that you got started. I'd love to just talk a little bit more about, as you reflect on that time, your years on the sell side, and now having done this for more than 2 years at Mastercard, just the differences in process and what you're trying to accomplish, and then perhaps portions of your skill set that you are still very much leaning on, that you were leaning on back then. What's different now in terms of the process and the audience, and where are you still leaning on a similar area of expertise and skill set?
I would say on the first one of the key differences is how do we think about markets? Wall Street, in my prior roles in the sell side, markets are the outcome. It's the output. We're all working together, trying hard, whether you're an equity analyst or an economist, credit analyst, to ultimately understand how markets will fare in some form or another. As an economist, we were forecasting GDP, we were forecasting inflation, but ultimately the goal was to understand monetary policy so that we could inform the path for interest rates, which then would filter through many different aspects of the markets. The markets were, in a way, an output, and I would argue today in my role, it's more of an input into how I think about the economy. I look at markets very carefully. I'm on Bloomberg constantly, not maybe as much as I was when I sat on the trading floor, but still a critical part of how I'm monitoring the economy. But I'm thinking about financial conditions in a sense of how to put that into our models, how to think about what it means for trends in the economy, with the outputs being overall dynamics in economic growth, whether it's what we're seeing for overall consumer spending, what we're seeing for consumer spending in certain sectors, what we're seeing for investment trends, what that means not just in a week's time, but what it means for where the economy will be in a year or 2 years or longer. And how is the economy potentially changing fundamentally because of some of the observations we have around the data and this business cycle. So I think that's probably one simple way to answer the first question, is around how we think about markets, financial markets in particular. To the second part of the question, which was what has stayed the same? What attributes are still being used? As a sell-side economist I use today, I would say that's actually a very simple answer, which is the ability to communicate economics. Regardless of who your audience is, it's the ability to take complex economic concepts and make it fun, enjoyable, digestible to an audience that's going to be approaching economics from lots of different perspectives with lots of different expertise. And that's one of the parts of my job that I enjoy the most, and I always have. I get great joy out of finding that other people can appreciate economics as much as I do, and maybe they didn't know how much they should be appreciating economics until they start to look at the charts and it clicks for them. And being able to help people get to that point of understanding the relevance of economics and how it could help them in their business decisions is extraordinarily rewarding.
Well, let's dig into a little bit more of the data that you're able to see now, that, as you call it, aggregated and anonymized, but vast. And maybe just to preview this line of exploration in our discussion, I had a previous guest, Mandy Zhu, on the podcast. Mandy ran equity derivative strategy at Credit Suisse and then moved to run market intelligence at the CBOE, the options exchange. I feel like there's a parallel here because as a derivative strategist on the sell side, you're analyzing implied volatility and various relationships. But once you move to a place like the CBOE, you're seeing so much transaction data. It's a very different vantage point, and I would argue a substantially richer set of data than if you were just sitting at a sell-side shop. And I'm just wondering if there are some parallels there. And so perhaps you could just tell us broadly, as you started to get an appreciation for this data that Mastercard through its global businesses is generating, help characterize it for us and then how you're able to utilize it.
The simplest way to think about it is being able to understand trends in consumer spending in real time, given the use of credit and debit cards. The idea of Mastercard is, of course, the rails, and we're able to see what moves through the system in terms of payments. And there's a ton of payments moving through every single second of every single day across the globe. So it's clearly very timely. It takes the concept of high frequency data to the next level. And it's vast in that it covers the globe, which is unique for high frequency data to be able to have cross-country comparisons or look at spending as people travel. We look a lot at tourism spending, and we had this big report out recently on the travel economy and the state of travel, where we actively and aggressively leveraged our data to understand cross-border spending trends. Then at the same time, it's also hyper-local in the sense that we can look at within the US What's happening on a zip code basis? What's happening on a county basis? What are we seeing if you're a state? What are the areas within that state where spending is looking strong, being weaker, and why? Is it a function of the labor market? Is it a function of migration trends? Is it maybe a combination of all the above? It allows for many more areas of exploration of the economy than is available just relying on the public sector data.
I feel like it certainly could be the labor market, but there are two other things I'd love for you to talk about. I picked up in preparing for this. One is the Swift effect. I thought that was just fascinating. We've heard a little bit about that. And then perhaps just talk about, boy, that chart was really amazing. The excess demand for goods and services along the path of totality recently for the eclipse. I thought that was just a really unbelievable chart. You've got some pretty interesting results from that as well. So it doesn't necessarily have to be labor markets. It can be these kind of one-off events as well.
Very much so. So I'm very glad you brought that up. The Swift lift is what we've called it, is one of the most exciting reports that we've published. It's always fun as an economist to be able to talk about Taylor Swift. What we did in the report is a little bit different than perhaps the other commentary you might have heard about the Swift economy. We didn't look at ticket sales. We didn't look at the standard indicators. We looked instead at how spending shifted across the US in the 20 cities of Taylor Swift's Eras tour. So to actually say, okay, in the zip code of the concert, on the day of the concert, the day before, the day after, what are we seeing in terms of spending at restaurants in that community or hotels in the community relative to a counterfactual of what might have happened if the event didn't occur? It's really quite spectacular. When you look at restaurants across those 20 cities, spending was lifted by an average of 68% per day over the duration of the tour in the immediate vicinity of the stadium, which we define as a 2.5-mile radius. If you look at accommodations or hotels, you get a little bit more diversification across the locations because it depends on the city and the capability to accommodate all of the visitors. But we see an increase in accommodation spending of 47% in the immediate vicinity. In some areas, it's even bigger. So Glendale, Arizona, which is where Taylor Swift launched her Era tours, spending in restaurants was up 169% within the 2.5-mile radius of the concert. So what does this all mean? Not only is it cool data, fun statistics, can we create really great visuals, which is what we do. And what I think we're known for is to create these beautiful interactive charts along with our research. But it tells us something very important about the consumer today. It tells us that this is a consumer that has the ability to spend, clearly. There's purchasing power out there. They're being selective. So when it comes to something like a Taylor Swift concert or travel or an experience, in some sense, they are price insensitive. They are willing and able to tolerate high prices. They're willing and able to allocate more of their budget to have that moment, to have that experience. But for other things where there's a lot more choice, maybe walking into a store where you are going to be waiting for the promotion, the sale, or you're going to buy in bulk, or you're going to trade down, that same consumer is doing that. So it's a bit of a paradox, but I think it really demonstrates the fact that this is a consumer that, in a way, is empowered and is making decisions in how they spend their money.
Of course, my daughter went to Taylor Swift at MetLife, and I'm sure we spent some money on that.
Potentially.
I was remembering, I want to say it was the Swedish central bank had made a comment that her tour there actually was going to impact inflation. And so my question is, are there instances with this and maybe perhaps with the excess demand that came around this path of totality where it actually flows through to important economic variables? And then sort of as a second part to that, economists like you are excellent at looking through things sometimes where you say, well, it's a one-off, maybe it's a strike or something like that. Bad weather might influence certain economic statistics and you're supposed to look through it. Has that demand been significant enough to actually make a difference in some of the statistics? And are you supposed to just sort of look past it?
For the US, it's hard to be able to say with any clear view that these moments in time are going to move the needle on aggregate for the overall country. But that said, you certainly can see local impacts The eclipse is the perfect example of that. We did a fun study that you're referencing, Dean, around looking at spending on hotels, dining, fuel on the path of totality, where you were able to see the total eclipse. And some of those small towns where people flocked to get that best view had a burst of activity and a significant increase in volume, a significant increase in revenue that probably made a difference for a long time, could still be making a difference. We looked at spending at hotels. If you looked at New Hampshire, this is for the overall state, so some of the local areas probably even more, but just in New Hampshire, spending on hotels was up 730% relative to what it would have been if the eclipse didn't happen. Those are big numbers. And you see a lot of smaller businesses in small local communities that had a very big boost. So for them, it's significant and it's probably still mattering. Is it going to move the needle for overall US GDP? Unlikely.
Well, as you've alluded to, a lot of your work is giving an opportunity to uniquely get a sense as to how the consumer is doing. You've alluded to it, but why don't you just give us the big picture when you step back and you look at the strength now in consumer spending and where you see that's going? Maybe first start there, and then we'll just talk about some of the subcategories. I know you've focused on leisure for longer, which, by the way, I'm raising my hand for that one. So that sounds good. But give us a big picture of the U.S. consumer and how you would score the current state of things.
So I think the U.S. consumer has navigated this business cycle, this post-pandemic period, very well. The consumer's been called resilient. I think that's right. The consumer is resilient in the face of what was high inflation, now high price levels, high interest rates. I think a term that really has resonated for me right now is this idea of an empowered consumer, that consumers have a labor market that's still working for them, low unemployment rate, job growth in excess of its historical trend, wage growth running above CPI or underlying prices of goods and services, and still a good amount of churn in the workforce when you think of the turnover. And on top of that, greater cyclical participation in the workforce. When you look at the prime working age participation rate, which has exceeded pre-pandemic levels on aggregate. So I think the labor market has been very supportive, and that is an extremely important statistic for thinking about where the consumer is and where the consumer's going. That said, as I noted before, this idea of resilience has been because the consumer did face a number of challenges. Prices increased rapidly for many categories of goods and services. Some now are deflating. A lot of big ticket items, durable goods are seeing price reductions, but it's after many years of increases, so it still feels expensive. And for some services, which just have stickier inflation, prices are still high and rising. So that's created some challenges for consumers. They've had to navigate that. And again, I think they've done it well, but they've done it by being selective in what they purchase, when they purchase, how they purchase. But they've had choices because we've seen a lot of new business creation and we've seen a lot of innovation in this cycle as well that I think has given more choice to consumers.
We've had a pretty unbelievable 4 years with the pandemic and the recovery and this substitution of almost entirely demanding goods, not being able to do things like travel. So the Amazon delivery folks were very busy dropping packages off at people's houses, but there was almost no travel, other types of leisure related items like hotel bookings and so forth. In some of your work, you talk a lot about airline travel, hotel bookings. I'd just be curious to learn a little bit more about what that says about the strength and durability of the consumer and what you see there.
We recently published our annual travel report where we look at the health of the travel economy. And it's impressive. Record number of travelers out of the US in the first quarter of this year. Outbound travel from the US elsewhere has been notably strong, which we can probably thank the dollar strength for. It has made it more attractive to travel abroad for Americans, particularly if you think about where the exchange rate is working the best right now, which arguably is in Japan. So Tokyo has been a hot market for travel. Folks haven't yet booked their travel. I think it reflects the fact that there's still a good amount of pent up demand that's out there for travel and maybe potentially a bit more of a structural shift towards wanting to prioritize experiences, leisure for longer, a more flexible work environment, a lot more options for consumers in how they spend. That could lead to a world where you can see a bit more travel or experience prioritization. Where on the other side, certainly non-durable goods spending has weakened. And frankly, there wasn't all that much price increases for certain categories there. I take apparel. When you think about the cumulative price increase in apparel, CPI metric shows prices are up, call it between 6 and 7% in apparel since the beginning of the pandemic. That's really minor increases in prices where, if you take overall transportation services, which is going to get a lot of that airfare, cruising, et cetera, everything's going to be in there. That's up 33%. So I think you can also consider the inflation story when you think about overall spending in nominal terms.
You talk a fair amount about the consumer doing well in light of just an ongoing strength in the labor market. I'd love to learn a little bit more when you look at that. Of course, there's your basic statistics of which you're an expert at and published by the BLS, and we'll get other info from outfits like the ISM and maybe it's the Conference Board. But when you look at the labor market, first, just tell us big picture what you see. Are there areas where you think the narrative may be a little bit misplaced in terms of it presenting as either stronger or less strong? What are some of the more subtle indicators you like to look at?
Let me take a step back first on the narrative. One thing that's very clear from this cycle is that this has not been a uniform recovery or a uniform business cycle. It has felt very different for different sectors of the economy, different locations within the US, different households, depending on their interest rate sensitivity and exposure. And I think that's created some confusion in describing this economy. The aggregate numbers do not represent the story on a more disaggregated level. And I think that you can suggest that's the case to some extent, labor market as well, when you think about the regional data in terms of where the job creation is coming from. It has certainly been the most impressive in the mountain states, where very strong and broad-based job creation, potentially in part because of the investment in green infrastructure filtering in, right, the CHIPS Act playing a role. The Southeast has seen a lot of migration, and along with that, a lot of firm relocations and a lot of job growth and income power in the region. Whereas if you look at parts of the Northeast or the Midwest, you haven't seen as rapid of a job recovery. So it has not been even across the country, and it has not been even across sectors either. We're seeing still some pretty solid job creation for leisure and hospitality, although last month certainly softened a bit. The construction sector has done well. We've seen pretty strong growth, and not just because of housing construction. That's part of it. We have a lack of inventory, but also because of manufacturing structures, the need to rehabilitate our infrastructure, which is now being invested in part because of the fiscal impulse. Whereas on the other side, the information sector, which is going to be your tech hires, lots of ink was spilled throughout last year around some layoffs in that sector, which certainly showed up in the data and now is flatlining. On aggregate, it's strong. We're seeing very healthy job creation. We're seeing a good amount of churn in the workforce. We're seeing wage growth hold up, but it's not going to be a uniform story.
Let's move to the inflation and monetary policy response. I think most of us, I'll put myself in the camp, have been surprised by the resilience of the consumer, of the economy, to a pretty epic hiking cycle, 500 bips in a relatively short period of time. At the start of the year, markets got pretty far ahead of themselves with expectations around cuts. But I think even those who didn't buy 7 cuts thought we wouldn't be where we are now. I'd love to hear your thoughts on that. When you look at inflation, just a little bit of how we got to where we are, this final mile, I guess you might call it, from 3 and change to 2. What does that look like from your perspective? Share some of your thoughts there.
So I think we've made a lot of progress in bringing down goods prices, or at least starting to. when you think about where the correction has occurred in the last 12 to 16 months. A lot of those durable goods categories that in part increased the fastest, they've now fallen. Most of the deflation is showing up there. There's a number of categories that have proved sticky. Owner's equivalent rent, your shelter component, it improved a bit last month, but generally speaking, it's remained a bit higher than perhaps desired, and it's a very large weight. There's a certain amount of what's being called stealthflation that's happening, where categories like motor vehicle insurance, where prices are still rising over 20% on a year-over-year basis. And if you look back, it's not just this year. For motor vehicle insurance, prices are up around 47% since the beginning of the pandemic. That's a very large price shock. Yes, I think we're getting closer to the target. We're getting back to more normalized inflation, but there's a lot of components within the shopping basket that still have a certain amount of inflationary impulse. And I think for the Federal Reserve, they're trying to find the right balance, which is they're not setting monetary policy based off what inflation is today. They shouldn't. They're setting monetary policy based off of where inflation is tomorrow. The trend has to work in their favor. And I think what happened in the first quarter of the year is the trend went the other way. We went from the second half of last year seeing continuous easing of inflation to all of a sudden a reacceleration or the apparent reacceleration of inflation in Q1. The April data reversed that a bit, which was heading in a direction that's more favorable. That movement in the data was sufficient to really shift market expectations in a pretty aggressive way. And I think for the Fed as well to tweak their narrative. We listen to Fed officials now. We need to monitor the data. The next move is to cut. They do not intend to hike again. That's not appropriate given where the business cycle is, I think. But the timing is going to be a function of when they feel like they've made sufficient progress on getting closer to the target for inflation.
And you mentioned financial conditions. Depends on what metric or what index of financial conditions you look at. There are a lot of them. I think almost every regional Fed bank has its own, but it's some basket of VIX and credit spreads and long-term rates and maybe the S&P level. It's kind of some version of wealth and liquidity and volatility. These indices are pretty loose, in some ways looser than when the Fed started its hiking cycle. Again, depending on which index you look at. What's your view there? Is that a big part of the monetary policy transmission or lack thereof? How much weight do you put on that?
The Federal Reserve transmits policy through the financial markets. We have to pay attention to that. But you also have to consider why financial conditions are easy. I mean, I think we know that part of the conduct of monetary policy is through guidance, so expectations. Markets will move in advance of the adjustment in rates, and financial conditions will therefore shift in advance. So the anticipation of cuts did help to ease financial conditions at the start of the year because the markets were pricing that in. And that does transmit and potentially did transmit to a stronger footing for the economy. So that's why it's very important for central bankers to be careful with their guidance, which I think they try to find the right balance where you want to provide forward guidance that helps economic agents plan accordingly to think about what the level of interest rates will be as they think about their debt needs, but at the same time, not overpromise or shift markets too quickly, too aggressively.
Last question, sort of related to this topic and the transmission of policy. I'd love for you to reflect on, and it's really where we started. Your career starts in the pre-GFC period of incredibly steep yield curves and teaser rates and low VIX and just a giant buildup of risk in mortgage derivative products and so forth. And if I think about the consumer or the homeowner's exposure to higher rates then versus now, it kind of seems like night and day. A lot of folks are getting more on their deposits than they are paying out on their mortgage, which is pretty darn rare. And I'm curious just about that in terms of monetary policy in light of this once in a generation opportunity that consumers and businesses had to term out this debt at very low levels and call it 2020 and 2021. How much of the maybe lessened impact of monetary policy is from your standpoint?
I think that's an extraordinarily important point for two reasons. One, I think it emphasizes how the financial system, the banking sector, is very different today than it was prior to the financial crisis. there's a lot more stability and ability to absorb shocks. That's been proven out in this cycle. The interest rate transmission in the US was more mild than it was in other countries. So to me, looking at the cross-country comparisons in this cycle was quite interesting when you think about in the US, where, to your point, Dean, the mortgage market in the US, there's a high presence of 30-year fixed rate mortgages, and people either purchase their home or refinance their home in a record low interest rate environment. And they've been able to stick with these low levels of interest rates. So even though the market rate is high, the rate they're actually paying for what is the biggest liability on their balance sheet is still historically low. Whereas if you look up north in Canada or you look at the UK, there it's higher presence of variable rate mortgages or short-term fixed rate mortgages. And that interest rate pass-through was faster there and more painful for a lot of households. So on the one hand, that means that, yes, there's stability in the financial system, which is good. There's an argument that there's a bit more resilience to interest rate swings in the US than maybe in other countries. But it also suggests that for the Federal Reserve, their job was a little bit harder. If their real goal was to cool down the economy and fight inflation, they didn't get as much support from their rate hikes. And it also could suggest that as we look ahead into the future, this whole argument of higher for longer interest rates could be quite accurate. Given what we have seen, given this idea that inflation could be stickier and potentially trend growth is also higher, that we could be entering this next stage where interest rates are also higher for longer, which is the narrative that Federal Reserve officials are suggesting to market participants now.
Who would have thought that the aggregate value of that prepayment option would have added up to what it actually did? It was tremendous. And, it's probably playing some role in blunting some of the impact on the economy through the rate channel. Well, Michelle, this has been a real pleasure. I've really enjoyed learning more about the work at Mastercard Economic Institute and getting a little bit closer to some of the very unique data that Mastercard's able to harness. And I really appreciate it. And thank you for your time.
My pleasure. Thank you, Dean. It's been fun.
Absolutely.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.